What is short selling NVDA? Definition: short selling NVDA involves borrowing shares and selling them, hoping to repurchase later at a lower price to profit from declines. Key differences versus long positions. Aspect: short selling NVD, a long position directional. Bet profits if NVDA falls, profits if NVDA rises. Borrowing required, not required. Risk profile: unlimited upside risk, limited to invested capital. Dividends: you pay dividends to lender, you receive dividends too. Step-by-step guide to short NVDA. Step 1. Check share availability. Contact your broker's hard-to-borrow desk or platform tool. Current NVDA short availability: approximately 1.2 meters shares. Step 2. Margin account setup minimum requirements: $25,000 plus. Equity: 150% initial margin, 130% maintenance margin. Step 3. Place short sell orders. Order type: use case for shorting NVDA. Example: market urgent entry during panic sell-off, sell 100 NVDA short MKT. Limit precision entry at resistance, sell short 100. NVDA at $120. Stop limit trigger after breakdown confirmation. Sell short if NVDA is less than or equal to $118. Step 4. Risk management tools. Stop loss: mandatory. Take profit. Scale out at support levels. Borrowing fee alert: monitor daily interest costs. Step 5. Handle margin calls and recalls. Forced buyback: if NVDA surges 30% plus, brokers may close positions without notice. Share recall: lender demands shares back, gives 3-day window to cover. Action: maintain 50% plus cash buffer. Use trailing stops to limit blowups. 3. Risks of shorting NVDA. Short squeeze triggers. Catalysts: earnings beat, AI hype, Fed rate cuts, historic squeezes. Plus 24% single-day move post Q1. 2025 results: cost structure, feed type NVDA cost, borrow fee 0.85%, year margin interest 8.5%, dividend payment 4 cents, share quarterly unlimited loss. Potential example: short at $120 gives NVDA hits $240. Loss equals 100% plus position value. 4. Indicators to short NVDA. Technical setups: ideal triggers, bearish RSI divergence at $130, resistance death cross. Volume spike on breakdown below $110. Fundamental triggers: slowing AI chip demand, PE contraction, insider selling clusters. 5. Risk management strategies. Position sizing rules. Max allocation: 2% of capital per NVDA. Short volatility adjustment: reduce size if NVDA for greater than 60%. Psychological discipline: pre-commit rules. Cover 50% at 10% profit. Stop out at 8% loss. Avoid revenge shorting after squeeze events. 6. Profit loss calculation scenario: price move profit. Loss formula: 5% drop, $114 plus $60. Times 10 shares, 10% drop, $108 plus $120, 10. Times 10, 7. Regulations and compliance: SEC Rule 201. Shorting restricted if NVDA drops 10% plus intraday. Pattern day trader applies if greater than 3 short trades, week in $25,000 account. Form show: brokers must report, fails to deliver. 8. Alternatives to short selling strategy NVDA. Example: pros versus shorting. Buy put options: $120, put at $5, premium limited risk. Leverage inverse ETFs: SQQQ, no borrowing fees, bear call spread, sell $125 call, buy $130 call, defined risk. Income generation. 9. Tips and cautions when to avoid shorting NVDA. Pre-earnings for crush risk plus surprise beats. Fed meeting weeks. Liquidity shocks amplify squeezes. Technical strength: RSI 30 or golden cross formations. Best conditions: too short. After failed breakouts at all-time highs, sector-wide semicon weakness, high put-call ratio. Disclaimer: this guide is for educational purposes only and not financial advice. Short selling carries unlimited risk and may result in losses exceeding your initial investment. NVIDIA is a highly volatile stock with a history of short squeezes. Test strategies in a paper trading account and consult a FINRA-licensed broker before live trading. Past performance does not equal future results.